Everyone, I am Ankit from Master Investment, where we seek to be better investor than we were the day before. Recently, we have seen a lot of market movements in the direction which no one likes. Some may say it's a correction, some may think market is going to crash and we are going to enter a bear market. Well, I don't know who is right and who is wrong. However, I know one thing for sure, that my favorite companies are now available at a better price than they were a week before. Nothing has changed from the company's business point of view, still generating loads of cash and growing at a decent rate of 20 to 25%. So the conclusion I derive from all of it is a sales season and I can buy my favorite company at some discount. You must be wondering what is the right course of action in such situations, where stock market is volatile and going in a downward direction. In this video, I will share with you what I did and I am planning to do in future if the stock market's downward trend continues. As usual, goal here is to understand how I came up with this approach and create your own approach that fits your goal and long-term plan. First thing I did was to calm myself down. It's natural to hit that sell button on your stocks trading app when you see your portfolio take a dive. It happened with me also, and I was about to sell my shares. So I closed my trading app and started doing something completely different to take my mind off from the stock market. This was the immediate solution that worked for me, and I didn't sell any stocks in the heat of the moment. Then I went through my long-term plan and read the principles and rules I want to follow as a long-term investor. This all helped me to achieve a mental state where I can think logically instead of emotionally. So important here is to calm yourself, do things that work for you, and do not sell your favorite stocks just because they're 20% down. Next thing I did was to reevaluate my favorite companies and see which one has gotten more interesting after the sell-off. Before I share how I reevaluated my favorite stocks, here are few things that I want to share that I assumed. Firstly, when I say my favorite stock or company, it means I already owned it or wanted to own it because I have already done my research in the past about the company and I know about its business and fundamentals. Secondly, I am a long-term investor, which means I hold the stock for at least 5 years and even longer. Keeping these assumptions in mind, let's check how I reevaluated my favorite stocks during this sell-off. First thing I check is the PE ratio and then I look at the revenue growth rate. If PE ratio is same or less than the revenue growth rate, then for me, the company is selling at a fair price. I will explain in detail the thought process behind this method in my upcoming video, so don't forget to hit that bell icon to get notified. For now, here is a brief summary. As most of you already know that price to earning or PE ratio is used by many investors to identify whether the company is selling at a fair price or is expensive. Usually, a PE ratio under 10 is considered that the company is selling at a bargain, and similarly PE ratio of 30 or more is considered expensive. Currently, we are in a different time where people are spending less and government is flooding the economy with loads of free cash. Not only that, because of current situation and recent trend towards green energy, many startups have come into picture and are growing at a rate of 50% or more every year. Because of all of this, more and more money is finding its way into the stock market, which have made many stocks very expensive if we consider only the PE ratio. So I think keeping the traditional way of stock analysis in mind, we should adapt a bit. Hence, as a quick hack, I consider both PE and revenue growth together to see whether a company is expensive or not. Confused? Don't worry. To understand it better, let's have a look at some of the examples from my portfolio and see why I sold or bought some stocks and for which stocks I have placed a buy order. I sold 3 of my stocks on 1st February 2021. These were Trade Desk, Appian and Zoom Video Communications. So let's take Trade Desk as an example. At the time when I sold it, it was trading at around $792. At that time, the PE ratio of this company was 161. At the first glance, you can see that it's way expensive considering traditional parameters. But let's see how expensive it is as per our method. For that, we will check the revenue growth rate of this company, and as you can see here, it was a startup and it grew almost 100% in 2016, then 50% in 2017 and 2018, which then reduced to approximately 40% in 2019 and finally to 25% in 2020. Well, this all is what was expected and nothing out of the blue. So being optimistic, let's assume that revenue will keep growing at a rate of 25-30% in the coming years and its price will hover around $800. Keeping these assumptions in mind, let's see how our PE will change. The reason we are doing it is the stock price always tries to match the earnings, which actually also makes sense. At the end of the day, we want to see our return on investment. I mean, a return of $10 per $100 invested is more attractive or a return of $1. Same goes with the company's market price and its earning. And sooner or later, either price will adjust or earnings should. Therefore, let's extend our PE in the future and see how it looks. Recent earnings per share is $4.95. To be honest, I should not take it as it is, as it has been increased because of one-time income from taxes and not from operations. But to keep things simple, let's extend the earnings using $4.95. So if earning per share increases by 25%, this is how it will look like in next 5 years. So after 5 years, it will be around $15, and if the stock is still selling at around $800, then the PE ratio will be 50. This means that we are paying a price today which is equivalent to the earning we will get after 5 years. Now I guess you understand why I sold it. But as it is a good company and I like it, I have also calculated a price range where it will become attractive again. Please note, I will observe the company's growth each quarter and will adjust the price accordingly. But for now, I want to calculate the price assuming my PE to be 50 and earning per share to be $6. This brings my share price to be around $300. Crazy, isn't it? We have already seen a price reduction of 35% and now we expect it to go 50% further down. Well, this is what the numbers show. Let's have a look at the chart in monthly time frame. If you see, there is even a support at this level. So I will place one buy order at around $310. At the same time, I will keep track of company's earnings and market price and will accordingly adjust my buy price. I think now you understand the thought process and idea behind revaluation of stocks, which was also the goal of this video. So every time when your favorite stock drops 20% or more, reevaluate it and check whether it still fits your plan and risk appetite. You can always adjust the numbers, that is PE ratio, growth rate assumptions, based on the company and the amount of risk you are willing to take. Here is the general cheat sheet that I use for myself, and you can adapt it or you can use it as it is. For growth companies and startups growing at a rate of 30% or above, I assume PE to be 50. For growing giants like Amazon and Apple growing at a rate of 15 to 20% or above, I assume PE of 25 or below. For slow growers like Coca-Cola or Moody's with constant revenue, I generally do not invest until unless they are selling at a bargain, which means historically low PE. With that said, market will continue to go up and down. However, as long as you have done your homework, you won't fall into its trap.